Many of the absolute best tax breaks in the US tax code are reserved specifically for real estate investors. These tax breaks are so powerful that some real estate investors are able to bring their tax bills all the way down to zero by using them. However, even though most real estate investors have the opportunity to dramatically reduce their tax bills, not all of them do. The main reason why some real estate investors don't reduce their tax bill dramatically is because they do not know the key rental property tax deductions that they could qualify for. In today's video, I'm going to break down the most important rental property tax deductions that real estate investors do qualify for. So if you are already an owner of real estate, or if you're thinking about buying real estate in the future, then this is a video that you're definitely not going to want to miss. Without further ado, let's dive in. Okay, here are the top 10 rental property tax deductions, beginning with number 1, depreciation. If you are not familiar with depreciation, it is the general wear and tear that occurs to a real estate investment property over time. This wear and tear either comes from tenants causing damage to the property in some way, such as scratching the floors, putting a hole in the wall, or from simply the passage of time. Things tend to break over time, right? Anyone who has ever owned any kind of rental property can tell you that this is true. The IRS allows you to get a deduction for the full cost of your rental property, not including the land value. If you own a residential property, the IRS allows you to deduct the full value of the building over the course of 27.5 years. And if you own a commercial property, the IRS lets you deduct the full value over the course of 39 years. Being able to deduct the full cost of your rental property building is one of the main reasons why real estate investing is so advantageous from a tax perspective. There are even ways that you can accelerate depreciation to speed up the amount of time that it takes to deduct the cost of the building. If you want to learn more about this, you can check out some of my other real estate tax videos or get a copy of my ebook, The Short-Term Rental Rule, in the description below. Next is repairs. Many real estate investors make repairs to their properties routinely. For example, light fixtures might need to be replaced, electrical wiring might need to be updated, walls might need to be repainted, and much more. These are just some of the most common repairs that a rental property owner might make in the year. But there are many different repairs that a real property owner might need to make over the course of a few years, a few decades, or even longer while he or she holds on to the property. The good news is that the IRS allows for you to take the full cost of these repairs deductible in the current year. Write-off number 3 is interest. Real estate investors are also allowed to deduct interest. This can include interest on mortgage loans, home equity lines of credit, and much more. The overall amount of money that real estate investors spend on interest every year can be thousands or even tens of thousands of dollars or more. So this write-off is extremely important. Make sure that if you're a real estate investor and if you're paying interest related to your real estate investing activity, that you're writing this off on your tax returns. Doing so can result in a significant tax savings that you really don't want to miss out on. Moving on to number 4, the home office deduction. If you run your real estate business from your home, and if you use this home exclusively and regularly for business, then you will be able to claim the home office deduction. If you do decide to take the home office deduction, you can do this with either the simplified or the actual expense method. The simplified method lets you deduct $5 per square foot to a maximum of 300 square feet. The actual expense method lets you deduct the actual expenses of running your home office, which you can calculate manually. In the vast majority of cases, the actual expense method, which is also known as the regular method, leads to a larger tax deduction for most taxpayers. Local travel. Do you own an LLC for your real estate business? And do you travel around from property to property, analyzing potential investments, checking on existing investments, or meeting with contractors? Maybe you even decide that you want to get in the car to go do some market research in your area. If so, then yes, you'll be able to write off the expenses associated with your local travel. And this is because business owners use their business vehicles for business purposes, and they can allocate the expense of business travel for their vehicles. You can claim the vehicle tax deduction and use the standard mileage method or the actual expenses method to deduct your local travel expenses. If you need help understanding the process of writing off your vehicle and local travel expenses, I have several other videos on that topic that explain it in depth. But what about long distance travel? Just as many real estate investors travel locally for business purposes, many also travel long distance for their businesses. For example, a real estate investor in Chicago might travel to the Dallas-Fort Worth area in order to conduct real estate business because he or she has properties there. Well, long distance travel is also a write-off that you can claim if you're a real estate investor. Long distance travel costs can include your airfare, train tickets, car rentals, hotels, and much more. So make sure that you're keeping track of all of your travel costs when you're traveling long distance for business purposes, because you will want to make sure that you have these expenses in the event you're ever audited. Casualty losses. A casualty loss is damage that occurs to your property due to a sudden or unexpected event, such as a flood, a tornado, hurricane, wildfire, earthquake, volcano eruption, or more. Hopefully, if you're a real estate investor, you will never experience a casualty loss. But unfortunately, natural disasters and destructive weather events do tend to happen from time to time, and properties are often damaged as a result of these things. If you experience a casualty loss for one of your real estate investments, then you will be eligible for a tax deduction in most cases. Employees and contractors. Do you have employees who work in your real estate business? Maybe secretaries, marketing professionals, property managers? If you do, then you will be able to get a tax deduction for the wages that you pay to these individuals. Karlton, what about my contractors? Now, I know that many of you have real estate businesses, probably also work with many contractors for things like repairs, renovations, landscaping, and much more. Well, the good news is that yes, you will be able to get a tax write-off for the money that you pay to these people as well. So whether you're paying a full or a part-time employee or a contractor, you will be able to deduct the costs as long as those costs are ordinary and necessary to your business. Professional and legal fees. Did you hire a lawyer to set up your LLC or create a contract for your businesses? Did you outsource your property management to a property management company? Or perhaps you hired an accountant to help you with your taxes. All of these professional and legal fees are tax deductible. These kinds of fees can add up quickly. And in fact, many real estate investors spend thousands or tens of thousands of dollars or more on these fees every single year. So being able to write them off can be extremely beneficial to reducing your taxable income and putting more money back into your pocket. The last tax deduction I'm going to talk about today is insurance. As a real estate investor, you get to write off insurance premiums for all of the various insurance types that you may have. This can include property insurance, flood insurance, hazard insurance, and much more. But the government considers these costs to be business expenses and therefore allows real estate investors to write them off. But how do we maximize our deductions as investors? At the beginning of the video, I mentioned a lot of real estate investors fail to maximize their deductions because they simply are not aware of the many deductions that they might be eligible for. While I went through this list, there might have been a couple of deductions that surprised you or that you were not aware of. But hopefully, now that you are aware of them, you will be able to increase your deductions at tax time if you are a real estate investor yourself. But I also want to mention that it can be extremely beneficial to make sure that you're working with a tax professional, such as a tax strategist, to make sure that you can claim every single tax deduction that you're eligible for. Now, in addition to telling you which tax deductions you're eligible for, a tax strategist can also help you to increase your tax deductions. For example, for real estate investors, you can take a large portion of your depreciation deduction in the first 5 years to 7 years of property ownership by implementing a cost segregation study. This allows you to accelerate depreciation. If you would like to learn more about maximizing tax deductions as a real estate investor, then I strongly recommend that you join my community, Tax Strategy Accelerator. I have loaded this community with valuable tax resources, my courses, my ebooks, my coaching call recordings, and much more. You can also network with other real estate investors, short-term real estate investors, long-term real estate investors inside of the community. If you're interested in joining, the link is in the description below. That's all I've got for today's video. Hopefully this helped you on your path to becoming a real estate investor. But if you could, be sure to like, comment, subscribe, and share this video with one other individual that you know who's going to be investing in real estate. Thank you so much, and I look forward to seeing you in the next video.